Hi everyone, welcome back to another lesson. If you're new to this channel, my name is Farhan and I help accounting students like you ace your exams. Today we have got a practice question for the topic correction of errors and suspense. In this question, we will learn how to identify the types of errors and also correct them using journal entries. Afterwards, we would be looking into the effects on the profit based on whether the profit is understated or overstated dependent on the corrections that we'll perform in the journal entries for assets, liabilities, expenses, and income. You can see the question on the left-hand side of your screen, and on the right-hand side, we'll have all the workings which I'll go through and explain to you step by step. This topic is exclusively available for students taking the 0452 or the 0985 exams worldwide. And if you're curious where I've taken this question from, this is from the variant 0985 October-November 2025 paper 2. All right, so with that being said, let's begin. Jaya is a trader. Her financial year ends on 31 July. The totals of a trial balance at 31 July 2025 did not agree. The first requirement is to name the account which Jaya would open to enable her trial balance totals to agree. So it is always the suspense account. When you prepare the trial balance, if you see a difference on the debit side with the credit side, such as the debits may be higher than the credit side or the credits may be higher than the debit side, that difference is what we bring into a suspense account. And the main purpose of creating the suspense account is that it serves as a holding account until you discover all the relevant errors in your business. Okay. Now, some of the errors which the trial balance cannot process are the error of omission because you have completely forgotten to record a transaction. So you won't be able to identify that amounts which are missing from the trial balance debit and credit sides. Another error, for instance, could be the error of complete reversal, where you have used the wrong accounts. You have debited the wrong account and credited the wrong account by the same amount, as a result of which the trial balance won't be really able to identify that. Okay. Now, this suspense account, as we have already talked about, serves as a holding account until you discover all those errors which the trial balance can't track by itself. Okay. And another purpose for the suspense account is also to allow you to prepare the unadjusted or draft financial statements, because as a business owner or as an accountant, you would be interested in the ongoing position of the business, so it can help you make your decisions better for the next financial period. Okay. Now, with that being said, let's look into each of the 5 errors that are given to us, and you'll have all the explanation and workings on the right-hand side, which I'll go through step by step. Starting with error number 1. No entry had been made for distribution costs of $320 paid by bank transfer. So it's very specific here regards to mentioning no entry had been made at all. So we can confidently say that we have an error of omission where the transaction was completely forgotten to be recorded by our bookkeeper. All right. Now we understand distribution costs of $320 is an expense that we have incurred. So if we want to correct this error now, we have to increase our expenses. All expenses by default must be debited, which means when you increase them, you must debit them. Therefore, we are debiting the distribution costs to reflect the fact that expenses are increasing by $320. Simultaneously, we understand that these distribution costs were paid by bank transfer, where you just gone to your mobile app and then just simply went to the app and then transferred the amount to the party who are responsible for this distribution, right? So your funds in the bank account are decreasing, which means your assets are decreasing. When assets decrease, we credit them. So we are crediting the bank account by $320. All right. Now let's go through the second error. Closing inventory had been recorded as $12,200 instead of $12,900. So this is what we can classify as an error of original entry, where the error is mainly within the numbers. All right. Now, we can clearly identify that closing inventory has been understated by $700, which is the mistake that our bookkeeper had made, where the inventory was recorded at $12,200 instead of $12,900, which obviously states that the inventory must be understated by $700, right? Now, as part of this correction, we want to fix our inventory by increasing the inventory balance by $700. Inventory in itself is a current asset for the business because you have economic benefits attached to this inventory, which you're likely to sell in the future to your customers and convert this inventory into cash and make some profit, right? Now, when we're increasing our assets by increasing our inventory balance by 700, we have to debit it because when assets increase, we debit them. So we debit inventory by $700. Simultaneously, we would be crediting the suspense account by $700 to come in and fill in the difference, all right? Because there are no other accounts that we can input in place of suspense. So we will bring in suspense to fill in the balance that is remaining on the credit side. So we credit the suspense account by $700, okay? Now let's go through the third error. Purchase returns of $95 had been correctly entered in the credit supplier's account but had been debited to the sales returns account. All right, so we want to understand what's going on. So we understand that there is an error of principle where the wrong classifications are involved. And how is that so? So we have had a transaction with our supplier where we returned some inventory to our supplier. Therefore, we have got purchase returns, right? But our bookkeeper made a mistake. Maybe our bookkeeper wasn't present enough and they recorded the transaction in the sales returns account. All right, so you can clearly see two different classifications because purchase returns and sales returns are completely different from each other, right? So how do we fix this? For us to fix this, we want to first know what should have been done initially based on the first sentence that is given here. Purchase returns of $95 had been correctly entered in the credit supplier's account. If we were to go through this first half of this statement, we can understand that the initial record that would be the correct way to do it would be to debit the supplier account by $95 because our obligation, our liability with our credit supplier is decreasing. And when our liabilities decrease, we debit it. Simultaneously, you would be crediting the purchase returns account because obviously we have made some returns with our supplier. And if when we buy, we debit purchases, and when we return, we must therefore credit the purchase returns account, all right? So this should have been the correct way to record it initially, where we would be debiting the supplier account by 95 and crediting the purchase returns account by 95. But what has been done? Now, what has been done by our bookkeeper is that our bookkeeper recorded the correct entry in the supplier account where the obligation of the liability was reduced. Therefore, the supplier account was debited by $95. But our bookkeeper missed out on the purchase returns and instead recorded the entry in the account of sales returns where the sales returns account was debited by $95, right? So that is a mistake which we have to fix. So how do we correct this? First of all, we clearly understand that there is no sales returns at all. Therefore, the error of principle has taken place, right? So what do? We remove the sales returns completely. So if the sales returns account was debited originally by 95 and we want to now remove it, the way we can remove it is to credit the sales returns account by 95, which was offset the previously recorded debit balance of 95. Isn't that so? All right. Then once that is sorted, we know that we need to bring in the purchase returns account, which we would have originally credited, right? Based on the correct way to record it. So therefore, we would be crediting the purchase returns account simultaneously by $95. So as we can see, the totals on the credit side is 95 plus 95, which is $190 in total. That must be the difference that the suspense account comes in and fills in on the debit side for a total of $190. So the point of correction for this transaction is to have three entries. So where we debit the suspense account by 190, we credit the sales returns account by 95, and also we credit the purchase returns account by 95. All right. Okay. So now let's go through the fourth error. A check for $225 received from ABC Wholesalers, a credit customer, had been correctly entered in the cash book, but no other entry had been made. So when we are receiving a check from ABC Wholesalers, who is originally a customer for us, our bank balance should increase. Therefore, we would be debiting the bank account. Isn't that so? And this has been correctly recorded by our bookkeeper. But our bookkeeper forgot the duality accounting principle, where every time we have a transaction, we got to have a debit and credit, right? So the bookkeeper forgot to record what needs to be credited, and that is up to us to fix. So we understand when we would be receiving the check from our customer who would originally be an asset for us would no longer owe us money, right? Therefore, we would have to credit our customer account because assets are going down, and we would be crediting the specific customer account in the sales ledger, which is the account of ABC Wholesalers. And simultaneously, now we have to prepare a suspense account on the debit side for $225 to come in and fill in the gap, okay? So we debit the suspense account by $225 and we credit ABC Wholesalers by $225. Obviously, as we understand, because our assets are going down once ABC Wholesalers, our customer, has made the payment, okay? Now let's go to error number 5. Property maintenance costs of $1,220 had been incorrectly charged to the land and buildings account. All right. So again, we've got an error of principle where property maintenance, which is an expense that we have incurred, has been incorrectly treated as an asset. All right. So what we have to do to fix it? We have to reduce our assets and increase our expenses. So when we reduce assets, we credit the land and buildings $1,220, which is the asset at cost account in itself, and simultaneously we debit the expense incurred account of property maintenance, which is $1,220. And as we have discussed many times before in previous lessons, all expenses are to be debited when they increase and by default as well. Okay, now let's see what's the next question. In part C, name 2 types of errors that will not be revealed by the trial balance. So we have already discussed this. So when we find the differences in the debit and credit values presented within the trial balance, there are many errors that we can't discover. So the question is requiring us to give 2, but we will talk about 3. The first one is error of omission, which we clearly understand that the bookkeeper forgot to record it or was not present enough to identify that one transaction was missing. Second, we've got an error of complete reversal, where you have recorded the debits and credits by the correct amounts, but in the wrong account, all right? So your debits and credits would not really be affected. In terms of the final totals, the trial balance would be reflected. Therefore, this is an error that the trial balance can't really pick. Lastly, you have got compensating errors, which is when errors cancel out each other. So let me give you an example. Let's say we paid $500 for rent, which is an expense, right? So we would have to debit the rent account and credit the bank account. But our bookkeeper, he debited another expense account, which is the wages account, all right, and created the bank account. So what's happening in this case is, while we were supposed to debit rent, which is an expense, our bookkeeper ended up debiting another expense account, which is the wages account, right? So now you can see that this debits, so this is what we can classify as an error of commission. I'm sorry. So this is an error of commission where we have the same classification but wrong account. And that is also something that the trial balance can't figure. But to give you an example of compensating errors, this is when errors cancel out each other. So for instance, like the debits and credits have been recorded by the incorrect amounts on both sides. Therefore, the incorrect amounts on both sides are kind of offsetting everything. So ultimately, there is no effect for the trial balance to pick, all right? So we have actually 4 errors that we have talked about already. So we have got the error of omission, which we have completely forgotten to record. Then we've got the error of complete reversal, where the wrong account had been debited and the wrong account had been credited by the same amounts. As a result, the trial balance can't really pick what was the mistake. Then we talked about the error of commission, where we had the same classification as we have discussed in the example for rent and wages, right? But we ended up recording the transaction in the account of a different expense compared to what we had, which is the wages expense instead of the rent expense. So that's an error of commission. So you would be debiting the same account anywhere, and the trial balance would be reflecting that total. And lastly, we've got the compensating errors, when errors cancel out each other, where you have recorded stuff on the debit and credit side, but by the incorrect amounts, as a result of which the overall effect is zero, which is what the trial balance can't really pick. Okay. Now let's understand part D in seriousness, because this is a different type of question here. So in part D, we are required to complete the table by entering the amount which GIS profit for the year would be overstated or understated if each error is left uncorrected. So that is the key word. Previously in part B, we corrected all the errors, but now they're talking about, hey, what's the effect on profit if we don't correct these errors? So for us to correctly answer this question, we would have to go through the workings for the journal entries that we had originally made. Okay. Now, I'll just bring the workings up for what we had originally done. And I believe you remember the transactions which we talked about. So starting with the first error. So in the first error, which is an error of omission, so distribution costs had been debited by 320 as part of the correction. So if we didn't fix this, we would be understating our expenses, right? When we understate our expenses, will our profit not be overstated? Obviously, it would be. So that is why we're recording $320 in the overstated column for error number 1. What about error number 2? So error number 2 is where closing inventory was understated by $700, right? So if closing inventory is understated by $700, the cost of goods sold that we calculate in the income statement will be overstated by $700. Isn't that so? Now, let me break that down further for you, all right? So I'll just add another page here and explain what's going on. Okay, so when we calculate the cost of goods sold, what is the basic or the most simplest formula of calculating it? So we start with the opening inventory, then we add purchases, and then we subtract any purchase returns, which I'm just writing PR in short, and lastly we subtract the closing or ending inventory, right? Now, if closing inventory is understated by $700, it means we are subtracting $700 less. So if we are subtracting $700 less, shouldn't that increase the cost of goods sold by $700? Of course it would. So if cost of goods sold increases by $700, then gross profit must decrease by $700, because obviously our cost, which is an expense in itself, is increasing. So obviously our profits should take a hit. So if gross profit is decreasing, then our net profit must also decrease. So the effect of not correcting error number 2, where the closing inventory was understated by $700, is such that the profit will be understated by $700. Does it make sense? Okay. Now, what about the third error? So in the third error, we understand we had purchase returns and sales returns and all those stuff. Okay. Now let's understand what happened in the third error. So in the correction that we have done in the third error, first of all, we credited the sales returns account by 95. But the mistake that was done was that the sales returns account was debited by 95 when we had no sales returns to begin with. So that means if the sales returns account was increased by 95, that is what it means by debiting the sales returns account by 95, shouldn't our net sales decrease by 95? Because now you have more returns, so your net sales as a whole goes down, right? Okay, so if net sales goes down, revenue goes down. So isn't it logical to say that profit should go down by $95, right? Okay, then in the mistake that was done by the bookkeeper, which is this entry right here that I'm circling on the left-hand side, there is no mention of purchase returns. So obviously purchase returns, which had actually taken place, was completely forgotten to be recorded. Now let's go back to the equation for cost of goods sold. So you can see purchase returns in this equation is also being subtracted. So if we failed or forgot to record a $95 of purchase returns, then that means we're essentially overstating our cost of goods sold by $95, which would again mean gross profit is understated by $95 and ultimately net profit is understated by $95. Isn't that so? Yes. So if cost of goods sold increases by 95, profit should again go down by 95 as we have just figured out. So altogether, the net effect is that the total profit decreases by $190 if we don't correct our errors. So that means we are recording $109 understatement in profit for error number 3. Okay. What about error number 4? So in error number 4, we understand that we received a check from our customer, which was recorded correctly, but we forgot to record the effect in the customer account itself. So regardless of whatever it is, when we would have debited bank, which is what our bookkeeper would have done, there is really no income and expense accounts that are affected. It's just one asset account. Sorry, it's just 2 asset accounts, which are the asset accounts of bank and the customer account of ABC wholesaler, right? Profit is affected when income and expenses are affected. Since no income and expenses are affected, we can confidently say it is 0. So no effect on profit for the year, all right? Now, let's go to the last error, which is error number 5. So in error number 5, property maintenance costs of $1,220 had been incorrectly charged to the land and buildings account. This means expenses were understated and assets were overstated, simply speaking, right? So if expenses were understated, therefore profit must be overstated, obviously. So that is why we are recording $1,220 in the overstatement column for profit. Okay. All right. So that's it. That's exactly how you score a perfect 20 out of 20 in similar questions in your exam in paper 2. If you found value in this content, make sure to drop a like, subscribe to this channel, and share this video with your friends. Check the links in the description for our intensive programs if you have your exam coming up very soon and you are not feeling confident. I'm here to help you excel. With that being said, I'll conclude today's lesson and I'll see you in the next one.